Hi, this is Adam Lobel from IPRG. I'm joined here with partners Zachary, Ziskin, and Zzeitchik, the heads of the Manhattan investment sales team here at IPRG. We're very excited to discuss a 2023 market report with statistics regarding the overall market for all multifamily and mixed-use property sales in Manhattan. We've also looped in a handful of industry experts, one who is a net lease sales broker, a very reputable landlord and tenant attorney, and a debt broker as well to talk about their respective industries. Throughout this quick segment, we're going to be talking about a handful of market trends and topics, in addition to a snapshot of key deals that sold in 2023. So in addition to having an unbelievable team, one of the biggest assets that we have at IPRG is our shared information system, which is our proprietary database. We've invested well over $1 million creating this, and we've tracked every single property that is sold throughout the 4 major boroughs, dating back as a group for over 10 years. So we've taken a lot of time, and our analysts have scrubbed through hundreds of transactions to ensure that we have the best data at our fingertips, and that is reflected in the report that we're going to be looking at here in a few minutes. Okay, so our research team put together this report for all multifamily properties with 4 units and more, and all mixed-use buildings in the $1 to $50 million transaction range. This is for all of Manhattan, every single property that sold in the 2023 calendar year. Overall, there was 188 properties that sold. This was down from 253 from the prior year, which is a 34% reduction in the number of transactions. The most active sales market last year was the West Village, Soho, Nolita, and Greenwich Village. There was a total of 38 buildings sold with an average price per foot at $855. The second most active market, according to the report, was the East Village and Lower East Side, which 34 buildings sold, and the average price per foot was $746. The next most active sales market was the entire Upper West Side, which was 59th Street all the way up to 110th Street. 33 buildings sold with an average price per foot at $719 per foot. So we broke this report into 3 main segments: the Upper East, Upper West, the Midtown market, which is 14th Street to 59th Street, and basically south of 14th Street. So across the entire market, the average price per foot ranged anywhere from $722 per foot, which in the Upper East and Upper West Side, the mid 700s per foot, $774 and $775 in Midtown and downtown. So across the market, the price per foot remained relatively the same across the market, but overall, the price per foot relative to 2022 was down 3.15%, as 2022 the price per foot was $771. So the big differentiator in the market from 2022 to 23 was sales volume, which turned out to be down 51.3%. Obviously the rent laws have had a big impact in the market. Rising interest rates have also, decreased the sales velocity pretty significantly. So the information in this map is the short abbreviated version of the overall report. Please feel free to reach out to either of us for more information about any of the specific transactions and for the full comprehensive information that was put forth. Now we're going to dive into a handful of the topics and trends that had a big impact on the market last year.
In 2024, the tone of the market has changed. Owners are seeking market information and resuming conversations on exploring value that they had previously put on hold. Despite the nature of the destructive laws and regulations, New York City has always proven to be resilient, and we can feel that confidence in the air when speaking to the active buyer base in Manhattan. Whether they believe that rates will drop, laws will loosen, or new programs will be instituted, we feel optimistic and very confident and poised for a strong rebound this year. One of the biggest topics of 2023 were interest rates and how the banks had responded to that. So in the second quarter of the year, we saw the collapse of Signature Bank, followed by another regional bank closing down, and we saw over 10 to 12 successive rate hikes going throughout 2023. Where we are today, I think overall, people in general feel more stable because the hikes have been put on hold. And now, more or less, when we look at a deal and we underwrite it, it's easier to pencil because we understand where rates are at right now. And even in the next 6 to 12 months, we forecast that rates are hopefully going to come down. In terms of the debt markets, there's over $2 trillion in debt that's set to expire over the next 24 to 36 months. Most of those loans were signed up during the peak of the market, 2015 to 2017, at interest rates about half of where we are today. So really, owners are at an impasse where they must decide, do I refinance my building or do I sell? If I go down the avenue of refinancing, it's going to be twice as expensive, and I might end up losing equity that I'd previously put into that building. So the conversations we're having in the market today are, does it actually make sense to sell? Where can my equity go? And, possibly through a sale and exchange, I have more purchasing power and can buy an asset at a greater cap rate with less regulations and less issues and challenges that may arise. Later on, I'll be speaking with an expert, a mortgage broker, who is dealing with this on a regular basis, and he'll provide some insight on 2023 and what the outlook is on financing for 2024. One of the other topics that everybody is talking about today is the rental market, and right now it is red hot. On unrestricted free market assets, we're seeing rent growth at a rate that would be difficult to quantify when you compare to the previous couple of years since the rent laws changed. Another thing that we're really focused on today is paperwork, being able to actually prove that the deregulation was done properly. And this is a make or break in the market. I've really never seen it at all play out like this in my 15 years of being a broker in Manhattan. One of the other issues that many of us are talking about today is the expiration of 421A. So 421A provided tax breaks for developers to build new units in the city. And, the best part about this program was it was helping this housing crisis that we're dealing with right now. All we need in New York is more and more units to be built. Because that supply is being cut off, it's actually helping to promote growth in a lot of these free market apartments. So it'll be interesting to see if any new programs are brought forth in the new year, that may open up the floodgates and allow developers to continue filing their permits and putting up new construction in Manhattan.
So a major trend that we're seeing in the market is for turnkey multifamily product in prime parts of Manhattan. And a lot of foreign capital is chasing this type of product, specifically from Asia and Europe. They have different tax incentives for investing in the United States, so they're able to pay lower cap rates, which today is considered probably in like the mid 5 cap range, compared to the local investor who can probably pay somewhere in the 6.5 to 7 cap range. Another common theme that's talked about throughout the market is the cutoff of supply in housing. Due to HSTPA being passed in 2019, it's basically cut off the supply of all rent-stabilized apartments being converted into free market apartments. Supposedly, there's somewhere between 50 and 70,000 empty rent-stabilized units right now. And then on top of that, we do not have a tax abatement program to build rentals throughout New York City. So this is essentially cutting off the supply of housing across the board, which is making it more expensive to live in New York for the local renter. It is just a supply and demand imbalance of deals, period. There's not that many properties being sold now. There's not as many on-market deals. So it actually, what we've found is it's actually boosted pricing somewhat due to the lack of supply of properties on the market, and ultimately money needs to be allocated.
So for the next segment of this presentation, we're pleased to bring in a handful of industry experts. Up first will be Russ Wachtler from the NNN Pro Group to discuss net lease properties. Then Ziskin is going to be interviewing Mike Lee, who's a very reputable debt broker with HKS. And last but not least, Justin will be speaking with Alex Fotopoulos, who's one of the top-rated L&T attorneys in New York City.
So I'm joined here with Russ Wachtler, a senior managing director with NNN Pro, one of the largest net lease sales groups in the country. How you doing today?
I'm good. Appreciate you guys having me on. How you doing?
We're doing great. So real quick, Ross, so I was looking at your profile and you sold over 700 net lease properties for over $2 billion in sales volume. You've represented institutional level clients, private equity groups, public and private companies. So maybe just give a little background about yourself and the company and what really is a net lease property?
Sure. So I'm part of the NNN Pro Group, where I'm a senior managing director. We're the #1 net lease advisory team in the country. At this point, there's over 100 people on the team spread out around the country who specialize solely on the sale of net lease properties. And I've been doing this for almost 20 years. I know I've done a lot of work with you and your team over the years, helping clients through the use of 1031 exchanges, get out of more management-intensive properties and entered the world of net lease, which is one of the most passive forms of real estate ownership. And to take one step back, what is a net lease? Essentially, a net lease is a relationship between a landlord and a tenant that holds the tenant responsible for everything at the property, including rent, taxes, insurance, maintenance, the works. And from a landlord standpoint, your roof leaks, your toilet breaks, you shouldn't even get a phone call. The tenant should deal with all that directly. And I view it as a form of real estate ownership that's going to continue to grow in popularity as people are looking to transition out of more management intensive assets and into more passive real estate.
Yeah, a lot of people say these are sort of passive investments with no management responsibilities, and the big benefit is that you alleviate yourself of all tenant responsibilities, and you inherit a corporate organization that is responsible for the lease, and the payments are made monthly, and that's one of the bigger benefits of owning that. Correct?
Correct. Yep. Especially, I know most of your clients are used to multifamily and 50 leases in one building, and just the headaches that come with that. So a little simpler on our side.
Yeah, so obviously the market up here for multifamily has changed a lot, from 2023 to 2024. In terms of cap rates, where are you seeing cap rates across the country on net lease type of properties right now?
Sure. So we're not immune to what's going on in the world, just like multifamily and other types of real estate. Cap rates are up across the board as interest rates have risen. But I would say if you're looking for quality net lease, there's plenty of options between, call it 5 to 7% returns today. That's unlevered, and with financing, it's a little bit more of a discussion. But they're up from where they were in the last couple of years. But with that said, there's healthy returns with real credits kind of across the country, and then we have properties local within a couple drives of New York, a couple mile drive of New York City, and across all 50 states basically.
Got it. And obviously, when a client is selecting a net lease property to have a lot of different options, like what are a handful of the sectors that you would say are the most in demand, or from a purchasing or ownership perspective?
Sure. So I'll lead with it depends. Part of our process is getting to know and understand and meet each client, assess if they're going to be more credit focused or more yield focused, and kind of finding where these clients might fall on that spectrum, and also just getting a better feel for what their likes and dislikes are, their beliefs on the world, and everybody's different. So I could meet with 6 different people on any given day, and they all have a different opinion on the world, and we're kind of pushing them all in different directions based upon what feedback they're sharing with us.
Got it. So some clients want, a 30-year lease with 4 or 5 different extension options, and other clients want short-term leases with potentially more upside for, if they renegotiate the lease in the short term. So we certainly understand.
Exactly, and everything in between also. So it just depends on kind of what we're trying to accomplish with each client.
So obviously your team focuses nationwide. Are there a few states in particular that people really want to invest in right now? Or how does that kind of look?
Sure. So especially being based in New York, I joke, I say half our clients here have a house in Florida that they live in for 6 months in one day just so they could get away with paying state taxes. But the tax-free states are always popular. You do have a larger audience in Florida, Tennessee, Texas, and some of the other income tax-free states around the country. With that said, I'd say the whole East Coast is pretty popular in our opinion, especially with buyers coming out of New York City. a lot of people we've seen have relocated as they retired down south, but maybe they haven't made it all the way to Florida. They're stopping in the Carolinas or Georgia, and then some of the other markets. So we're seeing tremendous growth in all these markets along the East Coast.
That's great. Yeah. So from our perspective, like we're really optimistic about where the market is going to go this year relative to where it was last year. What's kind of your general thoughts or sentiments about the net lease market going into 2024?
Sure. So no, I'm excited on the marketplace. Last year, I know across the board was more of a down year for several people. And if the last month or the start of this year has been indicative of how this year is going to go, I've taken more 1031 exchange meetings in the last 45 days, and I took the whole fourth quarter of last year. A lot more discussions, a lot more people just talking about the future and what they want to do with maybe some of the more management intensive assets, and net lease properties are an ideal place to be able to kind of park your money and kind of rejigger your portfolio, something that's more sustainable for people's family and maybe people that are just looking for a little bit less management.
Okay, cool. Well, we certainly appreciate your time. We're going to provide your contact information at the end of this presentation here. So if you're interested in learning more about net lease, we're happy to make an introduction to Russ and really understand your needs. And he does a really good job handling the client's hand, from the point of the disposition of their, asset in New York up until the acquisition of the reinvestment property. So thanks so much, Ross, and we'll certainly try.
Right. I appreciate it. Please feel free to reach out. Everything from novice investors up to the most sophisticated investors in the net lease space. We work with everybody. Part of our job is educating and matchmaking and making sure we help each client reach their goals.
Thanks so much, Ross. We really appreciate your time.
All right. Now, appreciate you guys having me.
Hi, so I'm here with Michael Lee, who's a mortgage broker and a partner at HKS Real Estate Advisors. Michael, thank you for joining us.
Thanks
You
for
and your
having me.
team, absolutely. You and your team have been active for over a decade, focused on the mortgage side. You've handled middle market debt throughout the city with a focus on multifamily mixed use. And as you mentioned to me before, your team is also active on a national basis. So you've seen all types of assets and deals in the market. I just wanted to give a brief intro to our audience, and then I'll give you a couple of questions, and we can talk. And I look forward to hearing about your insight and perspective in the business today.
Sure. Yeah. No problem.
So 2023 was considered by many to be a very challenging year to own and operate real estate in Manhattan, particularly multifamily real estate. One of the top stories was the downfall of Signature Bank, who amassed more loans by dollar volume in New York than any lender out there. They were the prominent lender of rent-stabilized buildings, which became increasingly difficult to finance since the HSTPA restricted a landlord's ability to increase rents meaningfully, in that business pipeline. And through capital improvements. So my first question, since the regional banking crisis became public, how have lenders been responding to imminent debt maturities in the market? And just along with that, the whole extend and pretend, is that still valid in the market today as well?
Sure. Yeah, good question. I think historically the last few years, people were happy to extend and pretend. I think in general, that's a strategy banks do use because, frankly, they have to put up deposits. They have to put up reserves against those loans if they're not doing well. So it actually behooves them to extend and pretend. I think what is clear at this point, especially in 2024, and we saw a big uptick in this in January, is, we're getting to that point where people don't really want to do that anymore. There's begun to be a lot more pressure from lenders to say, your loan is mature, or I've already given you extension, you're 3 months past due, you're 6 months past due, whatever it may be, we want to get paid off. And I think you're seeing that pinch now because there's a lot more urgency, there's a lot more movement in our side, and it's all revolving around maturity dates. I think that plays into the debt side of the business, but I also think that really plays into the sales side of the business as well. And so one of our things is, I think you really got to focus on what those maturity dates are. who the lender is, and if there's no more time, you really got to start making decisions on, is this a sale, is this a refi, et cetera.
Got it. And many of them are open to reworking the debt. Obviously, they're going to, scrutinize the financials a little harder than they did in previous years. But are they still open to reworking, even if value may have declined by 10, 15, 20%, whatever the case may be? Are they open to, refinancing the same types of properties, whether it be a regional or a national lender?
Yeah, so I would say it depends. A lot of loans do have an extension option, typically like a 5-year extension option. A lot of borrowers have rolled over loans into that extension option because, if you're not cashing out dollars, you're not dropping your rates, why pay closing costs on a new loan when you already have an extension option you can exercise? But a lot of banks are saying, okay, if you do take that extension option, we want to reappraise the property, we want to pay down, you have to re-qualify for the debt service covenant or the value covenant. And that can be a problem. So I think you're seeing some lenders do it, some lenders not. Some loans like a CMBS or an agency loan or some of the regional bank loans do not have extension options, and it's just time to pay up. And that can be quite a painful process to work through.
Got it. Okay. So if you're an owner that already has existing debt or you're looking to get down on your property, what's required of an owner today of a multifamily building to obtain financing in the market today?
For stabilized or free market or just in general?
Yes, so buildings in general that may have a stabilization component to them. Since the laws that changed 5 years ago, and we're assessing value differently than we did. The whole business has shifted. So essentially, what is involved? Collection reports and arrears. They want to see the real numbers. But is there anything more for a building that has stabilization? Are there lenders that won't even touch buildings now because of that? What are you seeing out there in the market?
So it hasn't really gotten to that point yet. What I will say is debt and lenders in general are typically lagging behind the market and the equity, right? The equity is usually the spear point that's pioneering into new markets, right? They're doing new things. They're converting buildings. They're doing things that are going to make dollars. On the debt side, it's a very low margin business. They're very slow moving and bureaucratic, and they're really not on the cutting edge of what's happening. So there's quite a bit of lag between the equity and the debt. And I would say to that effect, lenders will ask for leases, right? They'll ask for DHCRs. If there's arrears, yes, they'll ask about that as well. On something where you're buying and maybe converting units, they're going to ask, okay, if this is a free market unit and you're going to renovate it, we want to see that that's actually demonstrated. We want to see a letter from an attorney that actually can demonstrate to us that that's actually a free market unit if you're going to go renovate that space. But so far, we're not seeing anyone say, we won't touch rent stabilized buildings. We won't look at them at all. I think that's more of what the equity and the owners are saying is this is just not worth the risk, or we're just having trouble digesting how this is going to play out in the next, year, 5 years or 10 years. But so far lenders will still finance it. It's just tough to make the numbers work from a debt service standpoint, just given where rates are today.
Absolutely. And I can tell you, from the sales side, we're hitting roadblocks on a lot of these deals because once we start digging into the paperwork and retracing history, we'll see rent reduction orders from the 1990s. We'll see recent TPU audits on apartments. So they're really, hammering down the history on these apartments, making sure it's properly destabilized. And unfortunately, a lot of owners out there just, they weren't prepared for this. They didn't expect that you needed this type of history and content in order to sell a building in the market. So it's interesting to see the parallels on the sales and the financing side as it relates.
Yeah. And I think just an important point to point out, like most banks through this entire real estate cycle, when there was a stabilized unit, they were always just underwriting that market rent for that stabilized unit. They weren't really underwriting any bumps. They weren't really underwriting any increases on that. So, I think from a landlord perspective, if you're not getting a large percentage increase on that roll, that's a big downside, especially when you have a large portfolio. On the debt side, they were always underwriting the most conservative number anyway, and probably beating up the expenses anyway. So they were always sizing to that lower number. I think what will be more interesting to see is when these rent stabilized buildings start trading, that's going to obviously bring up cap rates, and that's going to start affecting appraisals. That's kind of starting to beginning happening now, and that will start affecting the appraisal values and start pushing down bank quotes and how that actually flushes out. But I think that will take a little bit of time to start working through the system on a neighborhood by neighborhood basis.
Agreed. Agreed. And I know cap rate is important. It's one of the biggest metrics that all of us follow in this business. And, I've been at this just as long as you have, nearly 15 years, and tracking cap rates in some of the primary markets of Manhattan, like the East and West Village, where, 10 years ago, I was selling 3 caps in the market. And today I'm selling 6 caps. Even good real estate, though, I'm selling below where the fund rate is. I'm still selling deals at a bit of a premium if it's juicy, protected tax class. There's huge value add, potential in the rates. I'm still able to sell to some of the mainstream players that are still going out and getting debt at higher yield. So what do you think, on their end, their business plan is if they're able to buy a lower cap rate, than where they're borrowing? Are you seeing that in the market? Or for the most part, they're trying to at least cover their debt?
Yeah, I think that's an interesting question. It's definitely highly dependent on the equity, right? I think you have some smaller family offices that are very, very value driven, and they're really not looking at anything at a low cap rate, and they really want a high cap rate return or a lot of value add component in order to get them excited. I think you have some of the older family offices or some of the bigger shops say, yeah, we're okay with that lower cap rate so long as we have free market rents. Maybe we have a nice retail piece. We're on a corner property. And we see that there's going to be really good rent growth over the next couple of years, especially if construction is constrained, there's not new supply. And especially if rates come down, maybe we're buying at a 5.5 cap, but maybe in 2 years we look like geniuses. So I think people are fine buying those prime bricks, right, in those good locations, if they think that rates will come down and that's going to be good play, or there's going to be good rent growth in those free market units.
And generally, do you see 5-year money, 7-year money? Do people still go for 10-year money? What's the typical loan term in the market today for a standard multifamily deal?
I would say historically, we probably have done 5-year paper is the most popular. That's probably 60-70% of the paper that we've put out historically. I would say another 15-20% is 7-year money, and maybe 10% or so is 10-year money. Today, I would say almost 100% of the paper is 5-year money on permanent loans with fixed rate product. Nobody wants to go longer than that. Everyone sort of believes there's going to be some windfall in rates at some future point, and they're going to want to come back and refi, pull out proceeds, whatever it may be, maybe sell the property in 2 years. So pretty much everyone's going for 5-year money. And in addition to that, everyone's trying to negotiate prepayment penalties to try and get as much flexibility as possible, which is always a double-edged sword, right? Because banks don't want to do something for free. And so you have to kind of get in the weeds and negotiate.
Yeah, we're seeing a lot of that too, where owners at a crossroads and their debt is maturing and they're figuring out, okay, let me kind of run dual tracks here. Let me start the financing and also try and sell the building. And now prepayment penalty is getting into it. So they really have to figure what course of action is going to suit their needs the best. So I appreciate that. To wrap up, just one last thought. Another big topic last year going into this year is interest rates. The Fed raised rates 11 times last year, leaving many owners in a predicament. Many of those that were either syndicators or family offices or a different type of investor that bought, from 2014, 15 through 2019, where debt was much cheaper. Just kind of understanding that. What are your thoughts today? When do you think rates are going to drop? What's your outlook on the market in 2024? Just kind of all together in the finance world, so what you're seeing in your position.
Sure. I think the first thing I'd point out on rates is a lot of people thought and said to me when rates first started going up that the Fed was going to increase rates and they were going to bring them back down and everything was going to be fine. And I think what we're beginning to realize in 2024 is we've really been at this for 24 months. It's clear that all the guidelines of, rates are going to get cut and be reduced has been pushed out further and further. First it was spring of 2024. Now it's end of 2024, right? Inflation is reduced, but still sticky. I think people are noticing the cost of taking a cab or going out to dinner is still expensive, even though the reported inflation rate is down. I think everyone's sort of feeling it in the pocket. But I would say it's very clear at this point that you really got to start acting on what do I need to do today to take care of my maturity date, my overall goals. Do I want to be in rent stabilized? Do I not want to be in rent stabilized? Do I want to be in the West Village, or do I want to move to another market? I think people need to start acting on what their goals are, and stop looking forward into the future of, that there's some silver bullet down the road that's going to solve their problems. Like if the Fed starts cutting by a quarter point at a clip at the end of 2024, that's not really going to bring your property value back to its 2019 valuation. I think you really got to say to yourself, okay, am I in this for the next 5 to 10 years, and can I go see this through until the next cycle? Or do I just want to refi? Do I just want to sell? Do I want to move on? And I think people are beginning to make those decisions now.
I think that's great advice, and I share that with a lot of my clients. A lot of sellers out there, they try and chase the market. They saw how good times were 5, 7, 10 years ago, and they're trying to get back to that point. And my advice to them is always, you should make decisions personally based on your lifestyle and your objectives and your goals. And the market will always be there. It's just about, taking advantage of the opportunity, selling for the highest price, or, hopefully being able to put together the best financing part. So absolutely.
Yep.
I think that's a great ending point. I really appreciate your time, and, to all of our viewers and clients out there, please reach out to Michael. He's fantastic, and he's done a lot of work for our clients through the years. So I really appreciate you spending some time with us today, Michael.
Sure. Thanks for having me on, and appreciate being here.
All right, you got it. Thank you.
Thanks.
Okay, so I have Alex Fotopoulos here from Corcomelis and Fotopoulos PLLC. Alex is an experienced landlord-tenant attorney. I have referred many clients in the past. We're actually working on 2 deals right now. He is I believe, one of the best in the business. Alex, if you want to introduce yourself, we can give the audience a brief explanation of your experience and kind of what you do on a daily basis.
Sure. So thank you, Justin, for having me, and hello, everybody. My name is Alex Fotopoulos. I'm a partner at Corcomelis at Fotopoulos. I've been representing landlords almost exclusively for about 10 years. I represent landlords in all aspects of rent regulation, so due diligence on purchases and sales, overcharges, all kinds of proceedings before the DHCR, Supreme Court litigation, including class actions and overcharges and regulatory coverage applications, substantial rehabilitation, housing court proceedings, anything that has to do with rent regulation, we do. I represent owners large and small, so I represent owners that have thousands of apartments and owners that have 1-6 family. So, we try to be as much of a full service firm as we can be in the rent regulatory arena.
So, as brief and efficient as possible, Alex, can you explain the major changes and amendments to New York rent regulation in 2023?
Sure. I'll try to be brief, but a lot happened in 2023. So there were 2 changes, or 2 bodies of governance that were changed in 2023. One was the Rent Stabilization Code, and that was amended by the November 8th amendments to the Rent Stabilization Code. And then there was the legislation that was signed into law by the governor in late 2023, early 2024. So the big areas that were hit, and I don't think I'll differentiate between both bodies of law, I'll just give you what the big changes were. The first was with respect to unit combinations. Prior to November 8th of 2023, when landlords combined units or created new units, they were able to set first rents. Those first rents were subject to stabilization, but you were able to essentially get a market rent. After November 8th, that is no longer the case. Unfortunately, combining or creating new units will not yield a new rent, but instead, the new rent will be a function of what the old rents were, meaning the two-component unit rents. That was the first big change, and it was really devastating, I think, to the industry because it really foreclosed on the last pathway to really creating value in rent-stabilized apartments. The second big change came with respect to substantial rehabilitation. Substantial rehabilitation still exists. And just to recap, that is a methodology by which you can deregulate all vacant apartments in a building. The changes to the rent to substantial rehab were as follows. One, there used to be a presumption of substandard condition if the building was at least 80% vacant. That presumption has now been eliminated. Two, you must now replace at least 75% of building systems, not only 75% of building systems. So we'll see what that means. And three, and I think most importantly, for substantial rehabilitations where the work has commenced after January 1 of 2024, an owner is now obligated to file for and obtain an exemption order from the DHCR. And that's a very significant change than what applied in the past, because it used to be the case that as long as you could prove your substantial rehabilitation, if you were ever challenged, that was sufficient. Now you know with 100% certainty that you're going to have to go before the DHCR and make your case. And the third change, or the third biggest change, I would say, to rent regulation, came by virtue of legislation that essentially modified or I guess revised the definition of fraud. So today, fraud is looked at as a totality of the circumstances test, rather than what it was under the Regina Metropolitan ruling, which was the common law elements of fraud. And what that really means, I think, is that the burden is still on the tenant to show that a landlord knowingly engaged in a fraudulent scheme to deregulate. But now there is a lesser burden, I think, in that the court or the DHCR can look at the totality of the circumstances surrounding a unit's deregulation rather than simply being wed to the common law elements of fraud.
Got it. So as of yesterday, news broke out that the Supreme Court has denied a case brought by property owners against HSDPA. What are your views on the outterm outlook on rent regulation for owners? Is there any hope, any signs of optimism that the real estate community can kind of hang on to?
Yeah, so I think a lot of landlords and a lot of people in this industry were surprised that the Supreme Court did not grant certiorari on any of the three cases, which were before it. There was the chip case that was denied certiorari several months ago, and then the two cases that were denied certiorari yesterday were brought by smaller individual landlords. It was interesting, Justice Thomas, in, I guess, the decision that denied certiorari, essentially invited a different landlord, or perhaps the same landlords, to file a more specific challenge to the rent stabilization law. I'm not particularly hopeful that we're ever going to get there through the courts. I think that probably where the change will come is from the New York State legislature. I'm not hopeful that we're going to bring back, or that the legislature is going to bring back deregulation, but I do think that as more and more apartments, more and more rent stabilized apartments remain vacant and the housing crisis intensifies, that the legislature is going to take a look at what it did in 2019 with the Housing Stability and Tenant Protection Act and maybe loosen up some of the IAI formulas. So, maybe they'll bring back a 140th or 160th formula on IAIs. Maybe they'll reinstitute some sort of vacancy increase. I know that there's a proposal floating around that would allow for a vacancy reset if an apartment was occupied for 10 years or more by a rent stabilized tenant and the owner performs certain, I'm not particularly hopeful that any of this is going to happen in the near term, but I do think that as this crisis intensifies, the legislature is going to be forced to act. I don't think that landlords, even given the ruling yesterday by the Supreme Court, are going to put these very low rent units back on the market. It almost doesn't make financial sense for them to do so. It costs them more, or it could cost them more to re-rent those units than it would just to leave them vacant.
Yeah, that's what I think the market desperately needs. I think the legislature step in. Honestly, I think people outside of the real estate community need to get more informed about what's really going on.
And you know what, Justin, just to piggyback on that, if you look at rent stabilization historically, from 1974 to 1993, there was no deregulation. At least there was no high rent vacancy deregulation. Starting in 1993, really in 1997 through 2019, you had this long period of what essentially was a pro-landlord regulatory regime. Landlords could deregulate apartments, landlords could buy out tenants, landlords could, really bring apartments outside of the regulatory regime. We're now 5 years into a different swing, which is a very pro-tenant, anti-landlord, regulatory environment. And, I think that things take time to change. Hopefully they won't take 20 years. But I do think that the market, is going to do its job here and is going to force, our politicians to, really act. I also think that, some of the labor unions might actually take some initiative here. As construction grinds to a halt because of the expiration of the 421A program, a lot of these very powerful labor unions are going to be looking to the governor and to the legislature, and saying, what's going on here? And maybe exerting some pressure to, help rekindle the rental market and the construction market.
Yeah, and on top of it, we've already had signature close got a business, and there's talks about New York community event potentially going under as well. So that think these laws have major impacts on both of their businesses. So that's a lot of jobs lost right there as well.
Sure, that is true, but I think the flip side of that is that this is probably, when we look back at this time, we're probably going to look back at this as a time of tremendous opportunity, right? The value of a lot of buildings in New York City is significantly less than what it was 7 or 8 years ago. So this is a point in time, I think, where, real estate investors, who have access to capital, can really pick up assets cheap. And, these opportunities are generally few and far between.
Yeah. So do you have any suggestions to owners on what they should be doing now in preparation for a future potential sale in, let's say, the next year or two?
Sure. So, the one thing I like to say to my clients is don't throw away anything, no matter how irrelevant or useless you think it may be. In preparation, every document or any document may be very important in the context of proving a rent or a deregulation. The first thing to do is get your DHCRs and your, DHCR cases by building in order. Identify when your deregulations happened. Try to get rent records, leases, IAI invoices, contractors' affidavits to show your deregulations. At the very least, you want to put together, the last 6 years at the very least of leases, for your, for each apartment. And, to the extent that there are DHCR orders on your account, if you want to try to clean that up, to the extent that you don't have leases or you had month-to-month tenants, maybe you want to supplement some of the missing lease periods with rent records. And you also probably want to talk to an attorney and a broker to try to put all of this together as a package so that when you do go out to sell, you're not playing catch up with a buyer where the buyer isn't identifying, or potential buyer rather, isn't identifying your problems. You want to be a step ahead of that, and you don't want to really be retraded because you're missing documents. Most of the time, if an owner has done things correctly, you can find the documents to justify your rents. It's just a matter of being a little bit creative, and it's a matter of getting organized. I think getting organized is probably, one of the most important factors that's determinative of your sale price.
Yeah, so can you touch upon that a little bit further? So I have a lot of clients that come to me and say, Justin, this unit was deregulated in 2002. That was 22 years ago. I don't have the canceled checks on hand, or I don't have the contractor invoices on net, and so forth. Can you explain to me what you can do for that particular client if they actually did do the work, that can help kind of remediate that type of issue?
Sure. So, again, I'm not offering legal advice. I just need to give that caveat. But in that situation, we want to look for the last rent stabilized in the first fair market lease. Maybe the first fair market lease has a rider that shows that that has proof of renovations. Maybe we want to look at the DOB to see if DOB jobs were filed. Maybe we can find the contractor who performed the work and get affidavits. Maybe there are subsequent fair market leases that we can use to try to justify a rate. Just because you don't have a document doesn't mean that you're out of options. Particularly if you're the owner that did the work, and particularly if you're the person, or you're the seller with the firsthand knowledge. In my experience, when a client tells me, no, I don't have something, or when a seller tells me, no, I don't have something, I never accept the first or second no as an answer. There usually always is more, and I see you're sort of smirking there because we've done this together. There's always more. There's always something someone hasn't thought of. And, it's really just a matter of pushing the right person, or trying to, I guess, get them to remember the right thing. And unfortunately, we live in a regulatory environment where there is no statute of limitations on the deregulation of an apartment. The burden is always on the owner to prove how the unit became deregulated. So yeah, it's bizarre, and it may sound, quite illogical, but we could be charged with finding or, obtaining information that's 20, 25 years old. That's the state of play right now, unfortunately.
Yeah, and absolutely. Ever since post 2019, facilitate a smooth transaction and really maximize value. It's really together the due diligence files is extremely important. We do a major role for what we do for the client, and that's just important in general for the client to have a team, whether that's the broker and the attorney, to team up to put the best package together to get the deal closed. So, Alex, I really appreciate your time with us. Your contact information will be present for any of the audience to reach out to you directly if they have any questions in regards to their LT needs. And then once again, appreciate your time.
Thank you, Justin, and thank you, IPRG. And, anyone in the audience can feel free to reach out. I'm happy to answer questions and happy to help you with all your rent regulatory
All right, so our general outlook for 2024 is optimistic. I can say myself that I've been the busiest in the first 45 days of the year than I was all of the back half of 2023. The major reason for that is there is some sort of market stabilization, meaning that we know where rates are going. They're not going up any further. If anything, they're going down. We just don't know how much further. So this has injected a lot of buyers back into the market because they want to acquire these assets before rates start to decline. Byproduct of that, we expect sales volume to go up. We also expect generational owners to enter the market to sell, mainly due to the political pressures. And then we expect a lot of transactions to occur where buyer groups are selling at a loss due to low maturities.
And then to bring things home, Zach Golub is going to be speaking about IPRG.
Hi, I'm Zach Golub, Director of Sales at IPRG. What originally began as a team of 5 brokers, IPRG has now grown to an experienced team of over 50 agents and staff. Feel free to reach out if you'd like to discuss opportunities to work together. And on behalf of IPRG, we wish everyone success in 2024.